Thank you very much. So, gold trades in a regime of almost constant geopolitical change. What seemed alarmingly corrosive just a few months ago, and by this I mean mere calls to invade Greenland or perhaps Canada, has long been overshadowed by events in the Gulf, which may yet cause a sharp drop in world demand as high energy prices impose a tax on consumers everywhere and create other second and third order effects. For example, countries dependent on energy and fertilizer imports possibly experiencing food shortages, which may then turn into civil strife. The situation currently can be seen as multiple overlapping theaters of conflict marked by fragmentation, of which tensions between the United States and the remainder of NATO and last week's split in OPEC are the most obvious examples. And let's look at current events this way. Right now, two superpowers are caught in vices of their own making, with their foreign policies now subordinated to the mid-sized powers they chose to challenge and intimidate. Admittedly, one of those superpowers is of a rather rickety nature, but their nuclear capability and ability to disrupt events means they remain in the superpower club for now. Conflict involving states such as Iran and Russia have very unclear timelines for resolution. And that means that inflationary shocks and the scope for demand destruction, especially for key oil and gas importers in East Asia and Europe, are correspondingly hard to design a policy response to. What does seem fair comment is the effect of the ongoing closure of the Strait of Hormuz is very underpriced. In all of this, however, gold has underperformed. It's down almost 20% as of the time of writing in US dollar and Aussie dollar terms. We need to ask what's going on. There are several influences. Recent performances, by which I mean the huge rally from December 24 to the recent high of 5,600, have been phenomenal. Gold's rolling 12-month Sharpe ratio, its measure of risk-adjusted return, hit historic highs recently, and that was good. But gold suffers periods of underperformance after hitting highs in that metric, and recent underperformance should perhaps be seen in that context. Real yields have risen as a response to events in the Gulf, and that has been a headwind for gold. I'll catch up here. Additionally, the dollar has benefited from a flight to safety. Now, there are two very good reasons for that, in my opinion. Firstly, the sharp rise in the price of oil is a balance of payments shock to oil importers. I'm going to refer to oil and gas somewhat interchangeably to some extent, but how much you're affected by one as opposed to the other will depend on where you are. America is a net importer of oil products, and that means that while it too faces higher prices at the pump, it doesn't face the balance of payments shock that a Korea or a Japan, a Eurozone or a China will face. Hence, the dollar is going to outperform in that environment. The second reason is the huge concentration of tech assets in America and the vast demand that tech-related capex has on America's economy. This isn't just a today thing, but it's in full swing right now. And it attracts foreign assets seeking outperformance, and that is underpinning the dollar as well. It's not a forever thing necessarily, but so far one constant seems to be that the behavior of the Trump administration has yet to visibly put a dent on this aspect of American exceptionalism, so far at any rate. And then gold itself has lately been trading a little bit more, or adopted some of the characteristics of a risk asset. Some explanations for that touch on the investor profile and portfolio demand being a very large part of total gold demand. That's true, but it's not uniquely so. There is evidence of positive correlation with the biggest equity index, and those indexes are being affected by what's going on in the Gulf. Gold is liquid, investors have made good money on the whole, and that allows those investors to sell if facing stress in other assets. On top of that, there's been a significant re-rating of the expectations of Fed policy since February. Until then, the powerful narrative behind gold's positive story was the expected program of Fed cuts in 2026. Those cuts were based on a somewhat bearish view of the American economy, and perhaps also on the view that President Trump would get his way and determine policy rates. Data didn't really confirm the first of those. The labor market showed resilience with the unemployment rate down, jolts or job openings data up, and signs of resilient consumer confidence, at least until April. So it was a stronger picture than some wish to expect. And I say wish to expect or desired. In addition to all that, there was no doubt that many observers bought into the idea that the arrival of Kevin Warsh would herald a new era of low policy rates. And it's not clear why, because Warsh has a good history of hawkishness on monetary policy, and he generally favors the inflationary side of the Fed's dual mandate and managing that. Of course, people say all kinds of things when they're out to get the big job, but judge a horse by its form, and this horse is a policy hawk in both light and heavy going. It's also likely that President Trump overreached with continuous threats to Fed independence, and that's to some extent allowed for the fact that Fed can tighten. But whatever, events have overtaken arguments about easing. The closure of the Strait of Hormuz has impacted inflation expectations enough that easing is all but out of the question this year. Market pricing for the level of Fed funds is almost 75 basis points higher for rates in January of next year at the beginning of this month than it was before hostilities started with Iran. So one thing I'd like to talk about and how it may affect gold are major disruptors that the world faces now, because those things will speak to gold's strength as an insurance asset. 2026 will experience huge capex spending by technology hyperscalers, most of whom are going all in on artificial intelligence spending. The scale of that spending is expected to be huge. Major technology firms projected to invest between 650 and 700 billion US dollars this year, twice last year's spend. For context, that amounts to about 2% of America's GDP, or the equivalent of adding a Singapore or an Argentina to the world economy. Some of that spending on compute is to establish market dominance as a priority over generating free cash flow. Investors are already passing judgment on equity valuations of the most dominant firms in US equity indexes as firms increase spend and gearing, and not all firms will emerge as the winners in this race for territory. Now, additionally, those firms are competing for power distribution infrastructure that is aging out. To give one example amongst many, transformers are aging faster owing to the demands placed by the rise in overnight electrical vehicle charging, something that wasn't factored into their design lives 2 decades ago. For transformers, as for humans, nighttime is supposed to be a period of rest, and the need to replace aging infrastructure in large countries such as the United States comes at a time when the technology sector is competing for even more infrastructure. That competition may drive real prices higher and supply chains tighter, and in fact we're seeing evidence of that already. What impact this huge spend on compute has on asset markets and on real prices in the economy isn't easy to map out, but the sheer scale places it in the first rank of known unknowns. Moving on to private credit, which is estimated at 2 to 3.5 trillion US dollar in size. That sector has been showing signs of stress and concern over real valuations for some months. Citigroup has warned that private credit tourists selling into a downturn poses a potential threat to corporate debt markets. Now, it's too early to say whether stresses in private credit comes from sort of somewhat temporary liquidity issues as opposed to actual performance issues. The distinction made by UBS's CEO, Sergio Ermotti. Right now, the message from most is that this is far from systemic. However, the world is in a tightening phase, and private credit may be a significant canary in the coal mine of formerly cheap credit. Thirdly, Iran. 60 days have passed since the start of the war, more than 60 today perhaps, and the Strait of Hormuz has remained blocked for longer than most analysts anticipated. An estimated 600 million barrels of oil and around 20 billion cubic meters of LNG is trapped in the Gulf, and the amount is growing day by day. Iran and other Gulf countries are likely to run out of crude storage soon, in Iran's case mid-May, leading to efforts to shut in crude wells, which will mean they take even longer to reopen. Deliveries of LNG from the Gulf are expected to stop completely from now onwards as the last vessels to leave reach their destinations. So far, the reaction of markets, crude and LNG possibly accepted, have been optimistic as to the effects of prolonged closure. Industry analysts now have a baseline assumption of about 1 billion barrels of lost crude production. And the initial impact is inflationary, but higher prices will lead to demand destruction, which is already happening in some emerging markets and across parts of Asia. And that demand destruction will lead to disinflation later. The first phase has been a headwind for gold, And the second phase is likely to be a tailwind. Moving from facts about seriously impaired supply, what next? Right now, it seems credible that US intervention in the Gulf is likely to leave Iran with a hard-aligned government number 4 that knows exactly how powerful the Hormuz lever is and how valuable their nuclear program is, and probably a nuclear deal that is better for Iran than the previous arrangement. Challenging any of the above would almost certainly require a ground campaign, which, as I suspect, is very, very unlikely. But then the war itself was something of a surprise too. US military inventories are also reported to be sharply diminished. None of the above are encouraging for a post-conflict scenario, with the positive exception that a cash-strapped Iran will not be in a realistic position to fund its proxies in the region, unless, of course, crude prices remain persistently high in the aftermath. Gold responds very well to uncertainty, and indeed, it's one of the biggest unknown factors, if you like, or subjective factors in recent years, given rising real rates and a resilient dollar. So whatever the post-Gulf conflict looks like, it's fairly likely to strengthen the case for gold. Now, turning to the dollar. The dollar, of course, is likely to fall in the short term if the Middle East conundrum is solved, or at least unblocked. However, the very long-term secular rise in the US dollar and its current high valuation in real trade-weighted terms owes a lot to huge inflows of international investment. You can see here the $26 trillion inflow of foreign money seeking American investments over the last 2 decades is a factor in dollar strength. Now, if US investments do start to underperform relative to foreign assets for a significant period, and that significant period has to be longer than a year for portfolio managers to reappraise things, then those flows will weaken and may even shrink on an annual basis. That would place the dollar under significant macro pressure, given concerns over US debt and more recently US governance. I really suggest all who are interested in the macro backdrop to both gold and the dollar pay attention to this important metric. And perhaps the most important resilient tailwind for gold. Global debt has hit almost 350 trillion US dollars. Astonishingly, that figure grew by almost $50 trillion in the last half-decade. Debt is an everywhere problem. It might have grown more rapidly in the developed world, but it's increasing everywhere. The risk of default, or as people quite like to call it, perhaps defiatization, is in at least some domains, will underpin gold as the world's best insurance asset. Gold is bullish in the medium term, bullish in the longer term. Certain levels matter, and you have to pay attention to those, but right now it remains in a bullish phase. In summary, disorder and uncertainty are persistent, and disorder and uncertainty are a key part of why gold is a valuable addition to investor portfolios. Like I said just now, look at America's net investor investment position for macro information on the dollar and keep an eye on that. And lastly, huge debt load remains key to gold's durable appeal as a portfolio diversifier. Thank you very much.